When we start making a list of the universally acclaimed masters of the investment game, then Warren Buffett is a name that no one can miss, and his love for dividend stocks shines just as bright within the arena of investors. But this raises the question, what even are dividend stocks? Why does Warren Buffett love them so much? How can an investor like him have so much faith in them? What are the risks involved in these? And so much more. So, if you want to know the answer to these questions and find out more about Warren Buffett and his views on dividend stocks, then stay with me till the end of the video. And before we proceed, please press the subscribe button and hit the bell icon to get an update every time I upload a new video on the channel. And now, let's dive in. The CEO and chairman of Berkshire Hathaway, Warren Buffett, is considered as the greatest investors of all time. And this is one of the reasons that the 92-year-old CEO is still working since he took over the company in 1965. Buffett increased the stock's value by 20.1% on a compounded yearly basis. Comparatively, throughout the same time period, the S&P 500's 10.5% yearly total return was nearly doubled. Until you understand the impact of long-term compounding, this difference might not appear significant, so let me break it down for you all. In order to put it into perspective, $1,000 invested in Berkshire would have generated $36.4 million. On the other hand, every $1,000 invested in the S&P 500, a sum of $302K would have been generated. And after looking at this example, you must know that this variation is quite significant, right? So the question is, how has he done it? In order to understand this, let us first look at what a dividend stock really is and how it generates profit to the investor. A stock dividend is a dividend payment made to shareholders that comes in form of shares rather than cash, so it turns out to be beneficial for both parties. It pays stockholders and still keeps the company's assets safe. Most of these equity payments are issued as fractions paid per outstanding share. Consequently, it is feasible to say that dividend stocks basically regularly distribute a portion of the company's profits to investors. So now you must be wondering, what's the difference between stocks and dividend stocks? Well, companies that pay dividends give investors a steady income, regardless of market fluctuations in stock price. Companies that don't pay dividends often reinvest earnings in the expansion of the business, which may eventually result in higher share prices and value gains for investors. Therefore, the former is more financially stable, although the latter sounds like the more thrilling option due to being a high-risk, high-reward situation. By investing in dividends, one can generate cash flow without having to sell their stock holdings. When dividends are reinvested back into the owner's holdings, this sort of investment has a significant compounding effect. Dividend stock investments can be made in one of two ways: by acquiring individual dividend equities or by purchasing mutual funds that hold dividend stocks, such as exchange-traded funds or index funds. Dividend ETFs or index funds provide investors with access to a portfolio of dividend stocks in a single transaction, allowing them to acquire a dividend stock portfolio with only one transaction. The fund will then routinely distribute dividends, which either be used as income or be reinvested. The advantage of dividend funds is rapid diversification. Even if one firm in the fund reduces or suspends its dividend, one can rely on the income from the remaining stocks. Reinvesting dividends, whether through dividend stocks or dividend funds, can significantly improve the return on investment by at least a few percentage points. For instance, historically, the S&P 500's total annual return, including dividends, has been around 2 percentage points higher than the index's yearly gain in value. This difference can accumulate over time. For example, a $5,000 investment with a 20-year growth rate of 6% might reach nearly $16,000. If you increase it to 8% growth and factor in dividends, $5,000 could become more than $24,000. Now that I've made my point about how dividend stocks are passive income powerhouses that bring in massive returns for Berkshire Hathaway, let me brief you about some of the companies where Buffett has his shares in dividend stocks. In the list is Coca-Cola, his longest tenured holding. Oil and gas giants like Occidental Petroleum and Chevron, financial stocks like Bank of America, Bank of New York, Citigroup, and American Express, as well as the tech titan Apple. So, I hope you can understand why he's so fond of dividend stocks, and I'm sure you've become a fan as well. Give me a thumbs up if you enjoyed watching the video. I'll see you next time.